Hello and welcome to SwitzerTV Investing. I'm Peter Switzer, and as the end of the year looms, I've found more time to interview Birmingham Invest Julia Lee and Tribeca Investment Partners June Baylor on a number of stocks we get asked about by many of our subscribers to the Switzer Report. Now those stocks are Appen, Xero, Pushpay, Nuix, Tyro, BWX and Northern Minerals. And Paul Rickard later will look at how you can invest on behalf of someone who you might actually care about. Well, we are getting close to Christmas and it could make a nice present, a nice big $1,000 or $10,000 gift invested in a number of really good stocks. We'll talk about that with Paul Rickard. So without any further ado, let's catch up with Julia Lee. Well, as per usual, catching up with Julia Lee at a time when the market had a pretty good day. I think the SPY futures suggested we'd be down, but we've headed up. Julia.
Yeah, the Australian share markets had a good day, mostly because US futures have been up about 0.5 to 0.6% during the session. And in particular, we saw technology stocks do well. Afterpay surged. It's going to be included in both the ASX 20 and the ASX 50 index for the first time from the 21st of December. So no doubt any short sellers would be closing out positions, which would help to boost the price there. But outside of that, the banks were very strong. Banks were up around about 1%. And then we saw it being the Christmas trading session, retailers in focus. Wesfarmers reached a record high. And we saw both the consumer staples as well as consumer discretionary sectors doing well. Unsurprising given the strength that we've seen in consumer confidence, as well as the strength of household balance sheets post-COVID-19, given all the stimulus that we've seen.
Did you say you were surprised to see that consumer confidence so strong?
Yeah, I think consumer confidence, I think I've been surprised at how quickly it's all bounced back. We've seen housing prices as well on the move up, and that's helped to feed into confidence. And of course, we haven't been able to spend on things like holidays. So I guess that's sort of gone a little bit into retail, but a lot of it's gone into savings as well.
Julia, you're going to start reading me every morning. I've been tipping this for about 3 or 4 months. Now, come on, switzer.com.au, read that first and then go into all your fantastic company analysis.
All right. Know I read it, Switzer.
I know you do. Anyway, let's go to a company that got a bit of a clobbering last week. And I think over the many years you and I have chatted, Appen's been a company you've liked in the past. What do you think's going on there now? And is it a buying opportunity for someone who's a buy and hold type of person?
Well, Pete, you obviously know I like Appen, so I thought today, instead of giving my opinion, I thought I'd read some of the broker commentary coming through after that downgrade. So starting off with Macquarie, they have an outperform on Appen. They said that the downgrade was largely backward-looking and the positive outlook justifies the continuing outperform rating. Citi also has a buy. They've retained their buy on the firm's potential to benefit from increased spending in artificial intelligence. They don't think that the recent lower demand points to a loss in market share. And then JP Morgan also has an outperform. They said that Appen's guidance downgrade is just a short-term blip and the AI firm's shares appear oversold, so looking relatively cheap. And I guess the thing about machine learning is that this area is expected to grow by 36% compound annual growth over the next 5 years. So if Appen only grows with the market, that's very strong rates of growth that we're looking at. So, you know, with these type of downgrades, I always ask, is it forever or is it a once-off? And Appen did say that because of COVID-19, the tech giants were a little bit slow in new projects. So hopefully next year, as those new projects build, we will see Appen's demand building as well.
Yep, and Silicon Valley is in California and they're locking the place down at the moment, aren't they?
Yeah, at the moment. So definitely going to be a post-vaccine story, but I think this would probably be the cheapest you'd be able to get in on Appen in a number of years.
Yep. Now Xero, and I've been informed by someone who's pretty intelligent who believes that this share price we're seeing now, which is shocking all of us, he thinks it's going to go a lot higher over the next 3, 4, 5 years. 3 or 4, 5 years, I'm saying. What's your view on Xero?
Well, Xero reached an all-time record high on the market today. And look, I think the best part of Xero is really the Australia and New Zealand business. I use Xero, and what I like is that the accountants all know how to use it. When you get an invoice, it feeds directly into the system because it's used so broadly in Australia and New Zealand. And I call this the network effect. But with the multiples that Xero's on at the moment, I don't think it's enough to get growth from Australia and New Zealand. What the market's really pricing in and what you're paying a premium now for is growth from international markets, in particular the US market, which is huge, as well as the UK market. And looking at the US market, you have much bigger competitors there, like Intuit, with much deeper pockets as well. And one of the lovely things about Xero here is that network effect. When you get an invoice, being able to put it directly into Xero because everybody else is using Xero or MYOB. Whereas in the US, you don't have that network effect. So I think it's going to be a much harder slog. So look, probably neutral on Xero. I do like the Australian, New Zealand business, but there's only so much you can grow in terms of hiking up fees to help boost revenue. User growth will probably bounce back next year post COVID-19, but it's really the US and the UK that you're paying for. And I think that's a much harder slog there to get growth. So I'm probably neutral here, especially given the valuations you're seeing.
Okay, let's go to PushPay next.
PushPay, look, I think that companies, when they're very much in favor, you hit a bit of a sweet spot, and there's easy profits or easy pickings in terms of profitability. And I think PushPay has reached saturation in that those large, massive churches over in the US. So they've pretty much dominated that area. For anyone that's unfamiliar with PushPay, it's basically being able to make digital payments when you go to church. And those mega churches have meant that PushPay has been able to grow quite rapidly. Now they've pretty much saturated that market. They're going to have to move on to smaller churches. So even if they move on to large and medium-sized churches, it's still going to be difficult to grow at the level they were when they were signing on these mega churches. So I'd actually steer clear of PushPay for the time being.
What about Nuix, a big float last week or the week before? Do you like this company going forward, Julie?
Look, I'm a fan of both Appen and Nuix, and I do like companies that are leaders in their area where it's very difficult to duplicate the business model. With Appen, in terms of artificial intelligence and the area they're in, there's only really two key firms in that area. And look, they need to hire millions of people to service those huge tech giants like Facebook and Google and Alphabet. With Nuix, it's a software and it's in the area of intelligence. So whether you're looking at customs or police, federal police, whether you're looking at ASIC, just trying to use data in order to pinpoint, I guess, things like financial fraud, payments that are going overseas, which might be illegal, and like the big four accounting firms use it as well. So look, you're probably looking at growth of more 10 to 20% for this company rather than Appen, where I'd expect more 30% growth rates. But having said that, it is a leader in its area. Very unusual to get a company of this quality on the Australian share market. The price is quite volatile at the moment, so I'd look to pick it up more around the $8 mark if I could, given that it does bounce around quite a bit.
Okay, you've talked about loving leaders in an industry. Zip is number 2. What's your view on Zip?
Yeah, I'd prefer to go with the leader or something really cheap, so one or the other. And Zip is neither. Look, I think Zip is looking cheap at the moment compared to the other buy now, pay later providers because the market's speculating that it's going to probably have to do a capital raising. And that's as it's targeting the US market, which has become a lot more competitive. So it'll need to spend more money in order to grow in that market. I think until it does that capital raising, you will see that discount being applied to the shares. So look, I'd probably, if I was interested in this one, I would get in straight after the capital raising when they've funded a lot of that initial growth into the US. But I'd prefer to be on something like Afterpay, or if you're looking for something relatively cheap, on Hum at the moment, rather than Zip, where the market is speculating that they'll probably have to do a capital raising.
Okay, while I'm on there, I did mention earlier this year or talk about my Zeet stocks, and Tyro was the T in the Zeet. What do you think of Tyro at the moment?
I like Tyro. Look, I think the big four banks, they're quite slow in terms of innovation because of the way their culture is, as well as legacy systems. It's a lot more difficult for the big four banks to be nimble. And in the area of merchant services, Tyro is quite reliable. It's very nimble. And I think there is an advantage in being a smaller company. So you are looking at EPOS payments with retail stores opening back up again. I think Tyro's in a good spot, and I think it'll do well in 2021. So obviously playing that retail recovery story. And I think retail is going to be very strong this Christmas season.
Okay, BWX.
Skincare.
Yeah.
I use a lot of the products. They also own the Nourished Life website where you can buy skincare products if you're looking for a Christmas present for the man or lady in your life.
See, you are pushing it.
Basically, they're looking to be a one-stop shop for natural skincare. So they own Suican, Andalou, as well as Mineral Fusion. So if you're looking for natural skincare, which is a growth area, especially in terms of the US and Europe, I think it's in the sweet spot, especially at the price it's at the moment. So we have seen a bit of a pullback in terms of the share price. So I would be happy picking it up here.
And finally, Northern Minerals.
Yes, Northern Minerals. Well, you know, I'm a lover of rare earths. We own Lynas in the portfolio. Lynas is the largest producer of scale outside of China. And you could say Northern Minerals is Australia's second producer of rare earths. However, you know, their Browns Range project, you could really only classify it, I think, as a pilot project, not a full-scale production. So they are aiming towards that. I prefer Lynas. I prefer production. But look, prices are going in the right direction. And as long as rare earth prices are moving up, then this share price should also be moving higher. One of the things that I do drill into when I look at investments is I do look at the shareholder register. And look, there aren't any huge institutions on this list. A lot of them are individuals. It seems to be dominated by either Chinese companies or people of Chinese heritage, which isn't a problem. You just want to see a bit of a mix in there, usually with the major shareholder lists, hopefully a few institutions backing the company and a bit of a mix, but there isn't a huge mix there. So just looking to see whether they can get some of the institutions on board, and that would be a positive move. But otherwise, moving in terms of its results with its results in terms of the mines it's looking to produce at, as well as the rare earths price, I'd prefer Lynas at this stage.
All right, Julia, as always, thanks for joining us.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, we're catching up with June Baylor from Tribeca Investment Partners, and she's a portfolio manager for the Alpha Plus Fund, which she whispered to me when I made a mistake when we did my intro earlier. How are you?
I am very good. Good to be here, Peter.
Same here. Last show of the year for you. And I'm really happy to be running through some interesting stocks. And these come from a lot of the inquiries we get when we do the Boom, Doom and Zoom show for our Switzer report subscribers. Let's start with a company that really reported in an ordinary fashion last week, and the market gave it a bit of a kick in the pants. But I like the company generally, Appen. What do you think is going on there?
Look, we like Appen. It's AI, exposed to all that AI spend and all of that. But look, what's happening at the moment is that it has benefited a lot just during the COVID lockdown. There was a lot of spend across all these search terms with the large guys. But the problem with, exposed to all these large clients like Google and Facebook and Microsoft.
Silicon Valley clients.
That's right. Silicon Valley clients is that you just need one of them to spend a little bit less, and suddenly your earnings visibility becomes very poor, because ultimately it is a contractor for that whole cloud AI sort of space. So so the client's spending a little bit less, and so that has caused a bit of a downgrade for the earnings. And of course, because its earnings majority exposed to offshore, so US dollar exposed, so without currency helping them in the last 12 months, it is going to put a bit of a hit to earnings. Now, I think the long-term story is intact. Now, short-term, there's a bit of a issue because people will build a bit of a story about whether the earnings growth is real and the like they always do with every downgrade for every company out there. So in the next 6 months, share price probably not going anywhere. But I think when it hit closer to that $25 mark, you do want to look into this business. It's one of the few pure AI exposure here in Australia. And I think the long-term story is still intact. There's a few question marks, but of course, in the short term, it's just being oversold.
Yeah. Do they have a competitive advantage over rivals out there? The fact that they're an Australian firm doing so well with Silicon Valley, it makes you think that their product is actually quite distinctive.
Oh, absolutely. Look, without the competitive advantage, they won't get those big clients, and the big clients keep allocating more and more money towards them as well. So of course, the margin is going to not going to continue to grow simply because they're getting a lot of volume. There's a lot of search terms because relevance is one of their bigger business. And so on these fronts, it certainly means the revenue is going to grow significantly, margin is going to be flattish, but still that's a good growth outlook for this business.
Being heavily exposed to California, with California going into lockdown with all their second wave infections, is there a bit of that in this as well?
Yeah, so part of the downgrade is because of the lockdown that's been impacting their earnings. It's harder for them to sell and get more income. But it is going to be a short-term impact, and in 12-month time, things will recover to normal.
Okay, I'm not going to tell you who told me this, but he's a really smart guy. And he thinks Xero is going to be a really big company with a really big share price down the track. Do you think that's believable?
Absolutely. I like Xero a lot, and I always regret whenever I take profit and in the company. It's done incredibly well, and it's every now and then people think we should be tactical, because recently share price rallied so hard against the rest of tech because it was included in the MSCI index, and that was a lot of buying volume.
The MSCI index.
That's right.
Explain it. We've got normal people watching this.
Of course, yeah.
What is the MSCI index?
Essentially, that's the global index for a lot of stocks, and there's a lot of buying.
She's an industry person. It's the MCSI.
MCSI, that's right. So those global index, whenever they include a stock, there's a lot of passive managers will have to go out and buy those stocks.
They track that index.
Exactly. And Xero, being a small, it's a large company, but in a global sense, it's a small company and doesn't have that many shares on issue. So the fund managers need to buy a lot of it as they go inside that index. So share price outperformed the rest of the tech in the last month or so, and it continued to go higher even after that inclusion. So many of us.
Why was it included?
Well, it was included 2 weeks ago.
But why?
Why? Because it got to a big size, and there's just enough liquidity for this company, so enough trading for this company to be a global business, really, to list on that front. So many of us thought we'd take some profit because of that, but you know what? It keeps going higher. So I do think it's a global business. It's demonstrated its ability to grow in the UK, to replicate Aussie and New Zealand business model in the UK. Very strong data, and the US is the next big thing. I'm a true believer of this stock.
Okay. Pushpay. A lot of people like it, but it seems you're having a bit of a struggle at the moment. And you're a Pushpay fan too, aren't you?
Oh, I'm more of an Afterpay fan.
Okay, right. Okay, you're not.
So yeah, I like a lot of those payment systems, but Pushpay has done very well during the COVID period. Of course, they went to the US and then they gained a lot of share across that payment across that church and charitable space.
So basically, it works in the church space, and we know Americans have a lot of very fanatical Christians who do often they do pay 10%, they tithe.
Yeah, that's right.
And during the coronavirus, a lot of people, because they weren't turning up to church, basically did it
they
online.
were paying. That's right. So it's a true beneficiary of that front, but it was gaining a lot of share as well during that period. So company did really well until a few months ago when the founder or the family sold down quite a lot of shares. So sort of reduced a lot of demand for that stock, and ever since then, it struggled a little bit. That we've seen this often, for a small stock, and suddenly there's a lot of share that's being sold into the market. It takes some time to digest. Look, I think it's doing well, but right now it's just being perceived as a COVID beneficiary, and what market wants to buy is the COVID, the next leg of growth, which is the company that's being impacted by COVID.
It's interesting you should say that because we've got going on in our market right now. You've got the old stay-at-home stocks or the new stay-at-home stocks that did very well during coronavirus, and we're moving into the reopening trade stocks, and now they're doing well. And I made the point a couple of weeks ago that some of those really good companies like JB Hi-Fi, who might be sold by fund managers to get their money, to take their profit, to buy the reopening trade stock, will eventually be liked again. I noticed today JB Hi-Fi is
significantly.
up.
That's right. Yeah. I think you're absolutely right. In anyone's portfolio, it's about buying a bit of everything. Buy the leader in every industry. JB Hi-Fi is so exposed to the consumer electronics space. It was winning share, was doing well even before COVID started. The COVID, of course, people were staying at home and setting up the home office, spent a lot of money on JB. So now that everyone think, next year, how are they going to comp this? Compare the earnings next year. But you know what? This Christmas is going to be amazing for this business. People still have a lot of money. They got their jobs. Housing market is doing well. Our economy looks like it's doing better. I actually think JB Hi-Fi is going to have a pretty good Christmas in the next 12 months.
Okay, let's move to a company that's been big in the news, Macquarie linked, Nuix, or Nuix, whatever. What do you think about this company?
Oh, I love that company. Clearly.
When she loves a company, she loves a company.
I love that company. That is a company you want to stay in. Do not take profits.
Is this like another Afterpay in that sense?
It's
different business, but we'll have the popular.
Yeah, it will have a lot of support. And what's amazing about this company, actually, it's been around for quite some time, and it has one of those biggest, most widest range of government contracts. It operates in that security, the data space. It's
at a time when security of data is really important.
That's right. There's a lot of big government contract. It certainly gives that credibility that this company deserves. And the earnings growth, of course, is not as high as Afterpay, but Afterpay is different. Afterpay is still establishing its market to see where it can go. This company actually got a solid contract and already signed those contracts for the last 10 years. And it's just been incredible and growing more and more through every one of those contracts. They involved with some of those most popularized or highly talked about stories, security stories or investigations that the company's heavily involved in. So it is a real business. It's growing at about mid-teen digits. It is. Yes, it's expensive, it's tech, but it's got very, very secure earnings, and it's highly regarded across that security space. So I think that the growth is phenomenal for this business.
Now, you've already mentioned you like Afterpay. What's your view on Zip?
Oh, I like Zip. Interestingly, we have seen Zip struggled relative to Afterpay. I think this is a reflection of what's happening in the small cap versus a large cap. Because if you look at the large cap tech, they have outperformed small cap tech meaningfully in the last month or so. Though they were the first one to get sold off when the rotation from growth to value happened, but now they got picked up really quickly. Look at Xero, look at Afterpay. Afterpay's over $100 now again. So
106 today.
And whereas Xero is getting sold off earlier. I think the momentum is very strong for buy now, pay later space. I think the next update is going to be very, very strong right now because small cap managers are selling off taking some of profit in those names, are buying the resources. Maybe it's the mineral resources and the others because resources are generally a little bit underheld across the small cap managers. So this is what's happening. But come January and February, when the earning comes around, these business will outperform.
So you're saying to our audience, there's a subtext here, and a company like Zip and probably Tyro as well, because Tyro is a small cap tech, but it's getting bigger all the time. You think they're buying opportunities at the moment?
Oh, absolutely. Tyro is, I don't want to use the word no-brainer, but it's
You have.
Yeah, that's right. Yeah. Look, I think Tyro is a great buy at this point. Share price being sold off a little bit unfairly, not on the fundamental basis, and not because of its earnings.
Because you said earlier to me when we started that the actual improvement in the business
is phenomenal.
They get weekly data.
That's right. Yeah. So you can actually, after Victoria come out of lockdown, so now the growth is now above 20% again, from negative 40% to now plus 20% year on year. So companies back into this growth trajectory caught up really quickly. So it is not only a tech, it is also a reopening stock. So but the share price struggled. Why is that? Because everyone was expecting it to be included at ASX 200, and the announcement came through last week. It didn't. So we are very comfortable in March it will, but that is just something technical.
Okay. And we should explain to our viewers, the ASX 200 index is not fixed. Some companies that lose favour because of their market cap drop out, and others because they're growing get put in.
That's right.
And when people like you, money hungry fund managers, but nice ones, think a company's going to go into the ASX, you guys buy them on the idea that this is going to be a buying opportunity, because some people have to buy the ASX 200 if you're running an exchange traded fund and have to have the top 200. But if the ASX surprises you and says, well, we're not including them now,
whoops, I
some
bought
people
all these
sell them
funds.
off.
That's right. This is especially true for the passive managers. These days, there's a lot of managers that manage passive money. That means it's the money that just track the index. So if index has this many stocks, they've got to include them. So the buying in anticipation means that share price, when it doesn't happen, the share price, they have to sell it. And the Tyro is not an overly liquid stock, so when they do sell it, share price will fall. And this is what's happening now, and that is the buying opportunity.
Yeah. So you're thinking the next time the ASX will review the top 200 companies, you think Tyro will get in there then?
Absolutely, you'll get in.
Okay. And I guess the growth that you're talking about will vindicate the fact that it should be in there.
Share price will be a whole lot higher by then as well. So it's absolutely will be the one.
Okay.
That's
She's very confident, isn't she? BWX, what do you think of this company?
BWX, I've followed it over the years. It's the key brand is the Sukin brand. The cheap
Sukin brand.
Sukin brand. Yeah. It's the natural skincare product that is priced at a lower price point. And then they sold through the pharmacies or the price line, and then they managed to gain shelf space across the supermarket. So it's been doing very well. Look, it went through its patches. Was going to China, wasn't doing well. And then went to UK, it was a bit slow, went through management changes, but now seems like it's back on track and that it's growing again. But one of my biggest concern for this stock is always you kind of, one brand just not going to make you, especially in that sort of skincare space, you do need to have a few more brands. So I do want to, for me, it's probably a hold. I do need to see them to, whether they acquire more businesses or, just have more range.
But it's not a stock that you think is going to fly high compared to the ones we've mentioned. So.
It's pretty expensive. It's done very well during the COVID period. So I do think there's value elsewhere.
It's a bit like McPherson. McPherson was doing very well during the COVID, but of course they've had a problem with their CEO and the share price was clobbered. That's
right. So some of the businesses, so in the COVID that you can see there's a COVID winner, COVID loser, and then there's a structural winner, structural loser. And McPherson was one of those COVID winners, but there was not a structural winner. So there's a pull forward of a lot of purchase of their products in the supermarket because there was a huge amount of traffic through the super, or not
I think
online.
even their cooking products did very well.
That's right. They all did really well. But now that the people can go back to the restaurants and that sort of demand sort of drops off. And McPherson is always kind of company with lower brand power company. So when people don't go through the aisles and see your product, people are just not going to go out and buy it. So weak business model will show through. And right now it's clearly going through a bit of patch. And next 12 months is going to be pretty tough. Okay, final one, Northern Minerals. What do you think about Northern Minerals? Yeah, look. Because you're talking about small cap managers getting into resource stocks. Is Northern Minerals one on your radar screen or? Look, I think that one is still a little bit far off at this point. I can tell you what are some of the things that the managers are looking into in the small cap space, especially. Right now, what's really interesting is the iron ore. Clearly, iron ore price pushing higher and higher. It's quite a crowded position, so people are buying those things. There's copper that people are going into. There's lithium is the interesting space that people are going into. Now, lithium is a little bit of a dangerous space because the people have lost a lot of money over the last few years.
Skyrockets the next.
That's right, and crashes. So you've got to be mindful because all of them have done very, very well. But the news flow so far is looking pretty strong, and with Tesla going higher and higher, certainly puts a lot of demand on those lower, those lithium producers and technology space.
Yeah, okay. Now, while we're here, because you do like the idea of buying quality companies when the market gets a bit silly. And I wrote for the Switzer report today that I thought Treasury Wine Estates and A2 Milk are good quality companies that seem to be affected by the current silliness of the market. China versus Australia, trade relations and all those sorts of things. Lack of Chinese tourists for A2 Milk. Am I right or wrong in saying that these are companies worth buying and holding for the future?
Absolutely. Look, I think
absolutely wrong or
absolutely right. Absolutely right. No, this is absolutely right. People get so fixated with the short-term panic, short-term uncertainty. That's why equity market is great because it creates opportunity.
Yes.
So everyone's scared of what's going to happen to Treasury Wine and the like. Share price is at just over $9. It would have been $20 if it wasn't this for the tariff. So people ask me, does a trade war has to resolve for you to buy this thing? No, because sitting at $9, 70% of or 60% of $9 is those premium penfold that is sitting in the finished goods sitting in the cellar.
Yeah.
So you're not paying for the company as much. You're not paying that much for the company. It's not going to stay cheap for long for a premium brand like that. So for us, the downside is very limited. And if the trade war gets resolved, which is not our base case scenario, share price will rally hard. So next 12 months, I think it will present a lot of opportunity for these businesses, and I think share price will recover.
Jim Baylor, thanks for your contribution this year.
Thank you very much.
We'll see you in the new year.
Absolutely.
And she's from Tribeca Investment Partners, the Alpha Plus Fund.
That's right.
Got it right,
Thank
didn't
you.
I? After all this time. It's amazing how I can remember something.
Thank you so much. Yeah, have a great Christmas.
Okay, coming up next, we'll talk to Paul Rickard about investing for your kids and anyone else you care about.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Joining me now is Paul Rickard, and he wrote a special piece in the Switzer report today about investing on behalf of your kids, or as I said in the introduction, anyone who you really care about. It could make a really nice present to dump a bit of money into some kind of a trading account or whatever and buy a few stocks. So Paul, thanks for joining us.
Thanks, Peter.
So tell us about what you were thinking about when you wrote the story.
Look, one of the things I know lots of parents and even grandparents think about is, particularly this time of year as we come to Christmas, is what can you give your kids, something they might actually value, not just on Christmas Day, but potentially in 10 or 15 years' time. And so, look, that's one of the issues that I as a sort of parent, looked at my kids and, sometimes think about how you can help them out. So that's really the motive, Peter. And, of course, it's particularly complicated for children under 18 because of the taxation rules and also getting things in their name. So that's one of the reasons for sort of just going through the options that you could potentially look at.
Okay, we'll run us through.
Well, let's start at the very basic. And if you just want a child's bank account, this is not so much investing, but of course, all the banks have what they call sort of bonus saver accounts, where you get a a very small amount of interest, and you get a slightly bigger amount if the child puts in a regular deposit every month. And you can get a rate as high as 0.80%. Now, that doesn't sound a lot, but when the cash rate is 0.1%, that's still not too bad.
Right.
The main thing to watch out for is, of course, is to make a regular deposit. Of all the four banks, probably Commonwealth Bank's got the best product, and Westpac's also up there as well, but I'd probably recommend the Commonwealth Bank to start with. One of the issues you're going to have to work with, of course, is just getting it in the right name, and there are special rules depending whether the child is under 12 or over 12, and also the issue of taxation, because the tax office has particular rules about who gets to declare the interest in their taxation. So it's probably best to put it in the child's name, and if you can keep the interest below $416, shouldn't be anything to worry about.
Okay, that's the bank account. Let's get into the more sexy stuff, investing in stocks on behalf of someone who you love.
Well, I think it's a great idea to have shares for your children. Mainly as an educational thing, Peter. I mean, I know, look, I got given some shares at a very young age, and one of the reasons that today I still have, obviously, a passion for the share market. So it's not about picking, in my view, it's about picking the best company. It's about picking some really great companies that will be around in 10, 15, 20 years' time, but also companies potentially that your child might have some affinity with. So, for example, you might invest in their bank. You might look at, if they go shopping, Coles or Woolworths. You might look at who their telco is, if they use Telstra. If they use Afterpay, for example, you might buy Afterpay and maybe a big miner they've heard of. So a company that you know is going to be around, something that they might have an affinity with. That's what I would try to get a portfolio potentially of 5 or 6 different shares. There are easy ways to do it. Things like CommSec still has things called Aussie Shares that's sort of like a self-starter pack. You can invest as little as $4,000 and get 5 shares that they select. And also most of the broker sites these days have micro-investing apps, things like CommSec Pocket, where they just invest in ETFs, and you can actually invest as little as $50. Now, it's not particularly exciting, but it's a long way. If they keep on investing $50 or you invest $50 for them every month, or, potentially over many years, it can build up, and you can invest in things like, the Australian share market, IOZ, or potentially look at the NASDAQ. So there's quite some different ranges with some of these micro-investing options.
Okay. But, Paul, if, for example, you really wanted to, let's say your child is over 18 and you want to open up an account for them, can you do that and put some money in?
Well, you can, Peter, but again, a lot depends on the purpose and who's doing it. So if they're under 16, it's generally no problem doing that, but the tax office will sort of look at the question. So I'd suggest that the best thing to do is, if you can, get your child to get a tax file number. It's not hard. In fact, there's no age limit. You can apply at any age to get a tax file number. You'll just need a birth certificate. So I think that's probably the starting point. You've also got to be careful of who's controlling the account. So it can be in the child's name, or it can be your name as in trust for the child, but who's actually making the decisions, and also how regular the funds are being used. So if it's just money going into an account and it sits there, unquestionably that's going to be for the child, and the child will potentially have the issue around potentially taxation, but they can earn up to $416 tax-free. Now, on shares, it's worth noting, Peter, that essentially you can get a portfolio of about $13,500 of fully franked shares, and there shouldn't be any tax at all for the child to pay. So that's about the break even. Yeah.
But the thing is just, why even worry about it? And it's good that you actually covered it, but the bottom line is, if, for example, if you opened up an account for someone, let's say they are 16, and you give them, say, $2,000 or $5,000, and you let them select their own companies, are they able to do that kind of thing with the current rules around, online sites like CommSec or NabTrade?
Well, it's a lot harder, Peter, because there's no rule that says that you can't own shares under 18, but there are some rules in chess that sort of stop some transfers. And as a result, some of the online brokers make it pretty hard for an under 18 to open an account. So normally what you do is you'd open it in your name, and you'd have an account designation for the child. And when the child turns 18, you should be able to transfer those shares to the child and because effectively their designation recognises that they're still the beneficial owner, there won't be any capital gains tax to pay. Yeah. Can I just go to what my personal favourite and the way I invest for my grandchildren, Peter, so showing my age here a little bit. Right. I really like insurance bonds. They're like some of the banks call them investment bonds, but they're actually the old insurance bond. Yeah. The reason they're called an insurance bond is they're issued by life insurance companies. And the reason I like these, Peter, is that they're set and forget investments, and it takes away all the hassle of ownership, potential tax issues, getting a TFN, and you can have effectively an automatic advancement to your child when they reach a certain age. So, for example, you can say put $1,000 into an insurance bond, and you can say that when they turn 16 or 18 or 22, automatically that becomes theirs. As long as the bond is held for more than 10 years, there's absolutely no taxation issues, no capital gains issues, no TFNs, no reporting to the tax office. It's really the easiest way to invest for a child or a grandchild. You do have to hold it for 10 years. Yeah. And you can add additional contributions, which is also a positive. But people like Centuria, they call them investment life goals, the AMP, Commonwealth Bank, IOOF, they're all the issues. They're called insurance bonds or investment bonds. Start from $1,000. They're my personal favourite if you're thinking about.
And nowadays, Paul, you actually can select various styles of investment. Once upon a time, they were very much like an annuity, weren't they? But now you could go for a high yielding investment bond or a high capital growth bond. And so a young person might get something like 10 or 12 years of high growth the stock market, and that $5,000 or $10,000 you put in could be a lot of money after 10 or 15 years. And
you're making a really good point, Peter. So I'd probably, like you, I'd go for a growth or a high growth options. They've all got lots of permutations, but keep it simple, go for growth. 10 years minimum is a long time. If the child is 5, you might say that you don't want them getting the money when they're 15. They're a bit young. Even maybe 16 or 17 might be a bit young. You might nominate 21, 22. Yeah. You've got a bit more maturity. So that's 15, 16 years of investment. $1,000, could be, added compound interest to that, 6 or 7% per annum return, and you're talking a lot of money by the time they turn 22.
Yeah, notice that Paul is such a tightwad. I'm talking 5 or 10. He wants to put 1 in there, but that's just the nature of the beast. That's all.
Well, if you've got lots of grandchildren, Peter, and I know lots of our audience do, and lots of people, lots of kids, and but I'm just glad that, Peter, that. If I'm your grandchild, I'll be looking to a minimum of $10,000. Is that right? That's my Christmas present.
Unfortunately, you're not young enough to be my grandchild, but if you were young enough, I would adopt you. That's for sure.
Thank you, Peter. I'll treasure that.
Paul Rickard, thanks for joining us. And that was Paul Rickard from the Switzer Report. Just before we go, I'd just like to remind you that we have the Switzer High Yield Fund, which is pre-listing. It will be listed on the stock market. If you want to know more details about it, just go to Switzer High Yield Fund on Google and you'll see all the details around that fund. Thanks for joining us. See you next week.